Hi, everyone. I wanted to go over part of our homework anyway to show you an approach on how to handle questions like this where it asks you for the asset effect and the account affected. Read carefully the question. It says, state whether each event either increased or decreased or had no effect on total assets of the business. Remember, total assets is everything. It's cash, it's current assets, it's long-term assets, it's anything that qualifies as an asset. So we're not talking about liabilities, and we're not talking about owner's equity or stockholders' equity. This is identify any specific assets affected. In other words, what account is going to go up and down. If an event has no effect on total assets, in other words, if the total assets, current and short term, is going to have no effect, then either classified as a personal transaction or as an asset accounts offset. Asset accounts offset is like, for example, if you have an accounts receivable on the books and then you collect it, well then, the cash goes up, but then the accounts receivable goes down, so there's really no net effect uh, to the total assets account. So let's go and look at what we're looking at here. The first one says, received $150,000 in cash and issued stock to a shareholder, stockholder. Basically what we're saying is that the business received $150,000 in cash and then issued some stock to a stockholder. Obviously, if the business receives cash, it's going to increase, and what it's receiving is actually cash. The only thing it's going to offset is it's going to, when it issues stock to a shareholder or a stockholder, it's going to put it into stockholders' equity, which is not a total asset. It's not an asset account. So what we have with this is an increase in cash. Go ahead and check, and we're good. The second one, purchased land. Land is an asset account for a building site and signed a $100,000 promissory note to the bank. So that basically a $100,000 long-term note or promissory note was signed over to the bank saying we're going to take the land. In exchange for that, we're willing to pay $100,000 out. In this case, they owe it to the bank. Well, obviously, land is going to go up by 100,000, and it's not an offset because the note payable, the promissory note, is a liability. So the net effect to total assets is that it goes up by 100,000. Let's go to the third one. Purchase supplies on account for $3,000. On account, remember, means on accounts payable. So we're gonna have more supplies. We're not gonna pay with cash. We're gonna pay on account, on accounts payable for 3,000. Accounts payable is a liability, but the supply account is gonna go up. So as far as analyzing total assets, we say that total assets are gonna go up, and of course, pretty much tells you what's gonna go up, the supplies account. Let's go to the fourth one. Tinsley used personal funds. Remember, Tinsley here is the major stockholder. Tinsley used personal funds. Personal funds means money that is not dedicated to the business at all, to purchase a pool table for his home. Well, that's not going to have any effect on the assets of the business. This is a personal, private situation. And it says here either classified as a personal transaction or an asset accounts offset. This is clearly a personal transaction. Look at E here. Purchased equipment for the business for $87,000 cash. Well, what we're saying here is we're saying that we're going to convert $38,000. Oops, I'm on the wrong one. Excuse me. Purchased equipment for the business for $87,000 cash. So prior to the purchase of the equipment, the business had $87,000 sitting in total assets. It converted $87,000 of cash into equipment. You can see how this is not going to have an effect on total assets because sure, equipment is going to go up, but correspondingly, $87,000 of cash is going to go down. Now, if they had bought this equipment on a note on accounts payable, then liabilities would go up and assets would go up. But this is basically just an exchange of one kind of asset for another kind of asset. Cash is going down by $87,000, which is part of total assets, and equipment is going up by $87,000. So this has no effect. This is the asset accounts offset, where one moves basically in and out of the same asset account. Let's look at F. You got $38,000 cash from customers for services performed. So you perform some services, so that's like revenue, and you receive $38,000 of cash. Well, obviously, if you're up at $38,000, that means you're going to increase. The only question is, what are you increasing? And in this case, what we're increasing is we're increasing cash. The other side of this entry is service revenue, which does not affect total assets directly. Look at G. You sold some land and received a notes receivable of $46,000. And it's simplifying things for you here. It's saying the land was carried on the books at $46,000. So there's no gain or loss on the land. Basically, you sold it for what it was on the books for. That just simplifies things for you. So basically on this, what you're exchanging is you used to have land on the books. Prior to the sale, you used to have an asset called land. Well, you sold the land, so land drops. $46,000 drops in the land account. Land is an asset account. But notes receivable goes up. Notes receivable goes up by $46,000. Because you have this asset called land go down by $46,000, and this notes receivable go up $46,000, notes receivable is an asset account. It's something the business counts as an asset. Basically what you have is you have a wash. You have no effect, and you're washing this basically through two different asset accounts. One asset account is land, and that's dropping, but correspondingly, a notes receivable for $46,000 is going up, so you basically have no effect. Let's look at H. In H, you earned $12,000 in revenue for services performed. So you performed some services and you earned $12,000. The customer promises to pay Landscape Deluxe in 1 month. Remember, in 1 month, if they're promising to pay in 1 month, that's an accounts receivable. So basically, we have service revenue of $12,000. We performed a service and we earned $12,000. But instead of debiting or increasing our cash by $12,000, we're increasing accounts receivable by $12,000. Accounts receivable is an asset account. So we basically increased, and what we increased is not cash, but accounts receivable. Let's look at I. Paid $19,000 cash on accounts payable. So you owed a business, somebody, $19,000. Well, that means that when you cleared that payable, remember payables, liabilities have a natural credit account, they have a natural balance of credit. So when you debited that accounts payable and you paid it, something has to go down. That liability does not come off the books for nothing. Well, you paid it with cash. Here, cash is going down and liability is going down. Well, liability is going down has nothing to do with total assets, but cash going down does have something to do with total assets. So we're decreasing our cash account by that amount. Last one. The business paid Tinsley a cash dividend of $5,000. Remember, this is in a situation where you're paying a dividend to this owner, this major shareholder. Remember, that's dividends declared and paid in this case. Remember, it's due, it's a liability when it's declared. In this case, it's actually being paid. When the dividend is paid, well, you have to pay that dividend with something. Something has to go down in order to pay that dividend. And in this case, it happens to be cash, a cash dividend of $5,000. So we're going to decrease the cash account by that amount. And that's our transactions. I wanted to go through them to give you an idea. The thing that's kind of tricky that you have to watch out for is these asset accounts. Well, obviously personal transactions where basically it has nothing to do with the business. They just bought a full table with their own personal funds. Personal funds is the money they have in their pockets. It has nothing to do with the business. And the other thing that's a little tricky is the asset accounts offset. Asset accounts offset is when one type of asset basically gets exchanged for another kind of asset. In this case, we had equipment on the books, or we purchased equipment, and that's great that equipment went up, so we have more equipment available for the business, but correspondingly on E, cash went down by $87,000. So you basically kind of washed out your total assets. I wanted to show you this just to give you an idea of how to approach these. I hope you found this useful.